Okay, today on the podcast, joined by Vince Scully from LifeSherpa. Welcome back, Vince.
Thanks, Glenn. It's great to be back.
Hey, the $3 million super tax that was talked about, there's been a change. Jim Chalmers has come out and said, no, we're not doing this. They pretty much could have got it through. They'd been talking about it for 2 years, then it went silent. Phil Curry in the AFR started writing on little chatter that maybe the PM's office got in on it and wanted to change a couple of things. So,
well, of course, the advantage of the PM getting involved, he does actually have a degree in economics, unlike our Treasurer.
Right. I didn't know Alvo did have a degree in economics.
It's on his website.
Well, there you go.
From Sydney University, of all places.
What's Jim Chalmers' doctorate in?
Paul Keating. He did the history of Paul Keating.
Right.
Which obviously is a really good thing if you're looking for advancement in the Labor Party.
Yeah. Hey, so the plan has been shelved, it's been changed. And basically now that there will be a change to the tax over $3 million. So what has been proposed?
Well, there's probably three key changes. So first of all, the $3 million is indexed and supplemented by a $10 million threshold where the tax lifts by a further 10%. The second change is that it's based on share of realised income rather than total change in balance. And the third thing is the fact that it's a personal tax now rather than a super tax. So just like a 293 or a excess concessional tax, you can pay it yourself or take it out of your fund.
Right. Okay. So we're going to talk about it in a little bit more detail and unpack it. My name is Glen James and you are listening to Retire Right.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glen James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glen is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so retire right.
The politics aside, obviously that has been what has killed this original plan because Jim Chalmers basically went to town initially like, this is happening. They baked it into the next 10 years of his budget. It was like $40 billion or something over 10 years or some huge amount.
Most of that in the back end. So there's like $1 billion or $2 billion in the forward estimates.
Yeah. And so as it stands at the moment, there has been no major detail announced, but they're splitting it up. So if you have over $10 million in super, that will now attract an extra 25% tax.
Yes, a total of 40.
A total of 40, yeah. And from 3 million to the 10 million will be the 15% additional.
Extra 50, so a total of 30.
Yeah.
And then the normal tax will be 15.
Right.
Or 0 if you're in pension phase.
Yes. Now, just talk to us about, so they've said that they will index it now.
Yep.
In line with the balance transfer cap.
Yes. So
maybe just explain to people how that looks in terms of the actual indexing, given that we do not have a lot of detail. Because
yes, we have a press release.
We've got a press release.
A media release.
A media release. We don't have legislation.
Correct. And we're not going to see the legislation this side of Christmas.
Yeah. And it's proposed to go ahead on the 1st of July next
2026. Yes. So for the financial year of the 27 financial year.
So I think the key takeaway is obviously the indexation and the not taxing unrealised gains.
Yeah, and this is sort of a masterstroke of political expediency because the key argument for the alleged inclusion of, or the incidental inclusion of unrealised capital gains was that rather than force the other 99.5% of the population who this didn't affect to account for all of this and build a system to deal with that 30% tax rate, it worked off the net change to the total superannuation balance. Convenient, everyone's reporting into the tax office already, no cost on the 99.5%, whereas separating out the portion of that is unrealised capital gains, because most people, know it or not, the unit price in your super fund includes a provision for unrealised capital gains tax. So your balance already has the future tax on unrealised capital gains included in it.
So and the whole reason, like, in one hand, I got it, sure, because that's how the world works already with unitised funds. But on the other hand, it's like, you want to tax me on a paper value. What could go wrong?
Well, it works fine for the Dutch.
Yeah.
But let's not, it's not exactly a major world economy.
Yeah.
So the super funds will report balances over 3 and 10 and will be able to attribute a portion of the return based on some reasonable basis, rather than have to running a separate pool of assets.
Right.
So that takes away a lot of the cost implications that the old system was trying to solve.
Yeah.
So you get the cost benefits, but you also solve a couple of the other problems at the same time. So I think that's positive.
Do you think we landed on a win?
Well, it depends on who we is, but I think the Australian taxpayer as a whole is better off, and it's certainly more palatable to the people who are going to vote on this in the Senate. So that's a positive. But the other big change, which also solves some of the arguments about, well, what about the family farm that's in my self-managed super fund? Both of them, is that you can now, like the Division 293 tax, you can pay it out of your own pocket. So
I thought you could have done that before this new change.
I don't think that was part of the rules.
Yeah, you could pay it either way.
Well, so why was the farm issue a problem?
Why is our farm in a self-managed super fund anyway?
That's just ridiculous. No, you cannot have a material farm because it's going to have to come out as a death benefit.
Yeah.
So it doesn't solve.
Yeah, like if someone dies, that
farm's got to come out as a tax benefit.
And it was funny because I saw a thing on ABC 7:30, right? And they interviewed these farmers when they would propose this tax, and they were like, "Oh, this farm have got assets." But you watch that article, the farm. They literally said our superannuation fund has investments. They were just farmers with a self-managed super fund with investments. So I think
if you're trying to solve
the train got away on that bit, I think.
And that bandwagon was jumped on by lots of rent seekers.
Yeah.
But the ability to do that, and the quid pro quo, which we'll probably come back to, is there's a lift in the low-income super tax offset, which I guess is probably key to getting the Green vote to get it through the Senate.
Yeah, and I think that was the whole, because they did not need the they didn't need the independents in the Senate.
Well, they needed them or the Greens.
The Greens, yeah. Well, I think the Greens were probably more keen on taxing big money than anyone else.
Yes.
But
I think it's a pragmatic solution to a nasty problem.
Yeah.
The notion of indexing tax thresholds is not common in Australia. We index a lot of retirement and super thresholds, but the key indicators of tax, the normal personal tax rates, the corporate tax rate, these are not indexed.
Yeah.
And so it is more unusual to index it than not. But I guess the confusion is, well, we index the contribution caps, we index the total superannuation balance cap, we don't index the 293 cap, the 250,000. So it's a bit of a mishmash, and it was just a convenient argument.
Do you think if this does get put to bed, and we're recording on Tuesday the 14th, this episode's going up in 2 days, it was announced over the last 2 days, there is still room potentially for let's have a look on that, because I think I don't love talking about politics, but for this measure, it's very political, because I think if the Greens won't wave it through, the independents will wave this through, because Allegra Spender, she said, paraphrasing, that...
Oh, your best buddy from the East?
That's right. she in principle didn't have a problem with it. She had a problem with the unrealized gains and the non-indexation, and that's what most people had the problem with. So I think it can get waved through, but there could still be some things, and that's why I think there is so much outrage online, at the bar, at the cafes, and it's probably political science where we put something out there, throw it out, let it simmer, see what happens, and then retreat a bit. And but all that to say, do you think if it got put to bed in its current form, it would make the system more complex, less complex, or just adds complexity?
Oh, well, I think it adds complexity, and there's still some serious detail to be sorted out. So the question is, well, what happens to a gain that is there today, an unrealised gain on the 30th of June 2026?
Yep.
Is it going to be taxed when it's realised, or are we only tax gains from 1 July? It would clearly be simpler to
How
tax
will
all
it
gains.
impact the run-of-the-mill unitised fund in its current form
Well, the
that
challenge
has those unrealised gains taxed, baked into the unit price?
Well, the super funds obviously know what the fund pre-tax income is, and they know what the total tax for the fund is, and they know what this CGT adjustment is. So reporting a reasonable allocation is a far simpler exercise than trying to go, well, what is Glen's individual capital gain? That's a really tough ask. Whereas, today they use a reasonable basis to allocate franking credits and gains across investment options and across members. So I think this is probably a win for the pooled funds.
Yeah.
Which is the lion's share of Australian accounts.
And probably a lot of the lobbying pressure, good, bad, or otherwise.
Yes.
But I mean, like,
given who the directors of most of these boards are.
Yeah. It's funny because it would have been in its form, like without the change, it would have been actually quite easy for the existing funds to roll it out.
No, well, yes, it was designed to be able to simply report the net change in your total superannuation balance adjusted for contributions and withdrawals.
Yeah.
Very simple calculation. Everyone knows what it is. It's reported to the tax office already. No systems work required really.
Yeah.
And of course, our big funds track record on big systems development is not good.
No. So I think the silver lining is for those who are like, well, what if a young person now doesn't get it indexed? As long as it's indexed, the pedestrian garden variety Australian worker probably will not hit that cap anyway.
Well, certainly not in my lifetime.
No. Like I just, it's a non-event, and we've always got to go back to I've been saying lately, Vince, fundamentals, it's not good when you talk about politics or religion. Keep away from fundamentals.
And money.
And
well, what are we doing today?
No, but I think fundamentally you can be a fundamentalist with money. Less tax in super, more tax outside, live on less than you earn. These are pretty fundamental things.
They are.
Would I rather pay 30% tax or 49%? It's pretty fundamental, right?
It is.
So we need to all have a cold shower. I think it is reasonable that funds that might have, $100 million in them, like, come on.
I mean, I don't think they really need a tax break.
No.
Your average plumber does not need to be subsidising people with $500 million in their super fund.
Yeah. So we'll keep on this as it develops over the weeks, but we'll be right back after this break.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia, so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Okay, we're back just on the tail end of that press release, and we kind of stumbled across this when we were going through the first proposal. It could have meant that people would be worse off by putting money into super and LISTO,
Yeah.
lower income super tax offset.
Yeah, there are some really odd interworkings at the lower levels of income where the Medicare exemption phases out and you salary sacrifice. So somebody earning somewhere in the mid-30s could potentially face a 36% tax on their super contribution, whereas they'd have paid 15 or 16 outside
of super, yeah.
So I guess part of the political calculus on this change is that they've brought in an increase to the low income super tax offset, or LISTO, where they've lifted the threshold from, let me get this right, $37,000 of income, taxable income, to $45,000, and the maximum amount lifted from $500 to $810.
Right.
So if you're in that sub $45,000 income bracket, your net super contribution will go up by about $310.
Right. So that's just a bit of housekeeping that they've caught up on.
Yeah. I mean, the rationale here is that super is taxed at 15%, whereas if you're earning less than 15, your marginal tax rate is 16. And so someone who pays 47% tax gets a bigger break for putting money in super.
Yeah.
And so this was an element to distribute the largesse a little more favourably. It's better than nothing, but it's still small, given the number of particularly stay-at-home parents who are mostly female still. And they obviously end up with lower super balances. So this will go some way towards fixing that, but it's still a pretty small change.
Yeah, cool. So there you go, everyone. A little bit of housekeeping there for the lower income earners that are not going to be left behind. Vince, in the Facebook group, I want to touch on this because I have seen it pop up now and again. Steve said, "Hi team, about to retire and having problems getting through to Australian Super. Over 1 hour wait for advice and 5 weeks to book a specialist appointment with their financial advisor. I tried Aware Super and got through in 2 minutes and booked an advisor in 10 days' time. They were excellent to deal with. Appreciate any opinions on Aware Super as I'm thinking of moving my funds into pension phase to them. Thank you." Now, I will just say, over the years, we've done paid campaigns with Aware Super and probably Australian Super. So I'll just disclose that I've probably received money from both of those funds. But it's not necessarily about those funds per se. I want to talk about the concept of, if you want a fast response bespoke service,
pay for it.
You will pay for it. If you want low cost, your financial advisor is in the super fund and there's 1 million members, there may be some delay.
Yeah. I mean, I think this is a trade-off that...
And maybe it speaks to intra-fund advice as well.
So a couple of things here. I mean, there's a trade-off that all of the big funds have to make here between cost and service levels. And so do you want to make 3 million members pay an extra $10 a week so that you can have a 1-day response time or a 5-minute call pickup on those odd occasions where you're going to have to do this? And so that's trade-off number one. The second thing I would say is that this sort of, most of the big funds erred on the cost saving side, and many of them have outsourced their call centres. So it doesn't surprise me the experience that you had with Australian Super, and so
and to add insult to injury, there is half the financial advisors in Australia than what there were 6 years ago.
Yep.
So there is a shortage of actual advisors.
Now, the second point I would make is that given the number of times you need to have these calls in your life, response time is probably not number one on your list of criteria for choosing a fund, especially if you're about to move into retirement.
Yeah.
So how you manage the withdrawals from your account-based pension is a much bigger determinant of the outcome. So
Yeah.
I don't condone those sort of wait times, but there is a price trade-off here.
But there's also, and this is why I really wanted to touch on this. So every single company at the moment seems to be doing some super rating or review or score system, whether it's the Vince Scully 5-star accredited fund and all this CanStar and blah, blah, blah. I don't love these ratings because what actually matters with my superannuation and my parents' superannuation, what's the money invested in? Will there be liquidity? Can they run the friggin' fund? Like, number one, is there transparency? Is there any issues with doing withdrawals and all that? The problem I have with some of these CanStars and Chant West and Finder and I think the lady who does Epic Retirement, like she's got her own scoring
there's some
system now.
retirement influencer who's just launched one.
The problem is they're rating funds on metrics like call times and call center response that, quite frankly, I don't think matter.
Yeah. I mean, they mattered when you're making the call.
That's right.
But over their life,
step
they
back,
don't.
I want a fund that's going to process my withdrawal of $10,000 for my trip within 3 days, and there's cash going to be there.
I mean, maybe they should introduce a $500 fee for a personal call, and so that those who use the resources pay for it.
Yeah.
Just an interesting example. Colonial First State have 500,000 members, and they get 4,000 calls a month. That's about 1% of the members call up every month with a query that amounts to advice, which they can't answer.
Wow. So there's a big problem.
This is a huge problem.
Yeah.
And outsourced call centers are not the solution, whatever the problem is.
Yeah. So I think everyone, we just need to have a cold shower. Sure. But it's interesting. It's chalk and cheese. Australian Super, 1 hour call time. Aware Super, 10 minutes. But yeah, you kind of get what you pay for. And I'm not saying because the advice is cheaper when you go to your fund direct and they can provide intra-fund advice, and I'll get you to explain what that actually means. That is cheap. It's subsidized by all the members. There might be a wait. What's the problem? Like, sure, as their internal business metrics, they probably don't love that their customers are on hold for an hour. But I don't know. It's going to get more of a problem as this aging population needs to retire and get advice.
And the question in my mind is, is it fair that a 25-year-old with a $5,000 balance is going to subsidise advice for someone with $500,000 about to retire? That doesn't strike me as being particularly fair, and that's the problem.
If you're a communist, it's fair, Vince.
No,
you're a communist.
I don't think Carl would think that was fair. That Carl would probably have it the other way around. So this whole concept of services being paid for by the entire fund membership through their service fees or membership fees, which are being provided to a select subset of members, is problematic.
It doesn't happen anywhere else in society. Maybe tax and your hospital healthcare system, maybe.
Yeah, maybe. But the challenge here is people expect these super funds to provide advice. All of the research, all the market research that the FSC or other people do, most people expect to be able to phone their super fund and go, the market's just tanked, should I move to cash? The law prevents that in general because that's personal advice, and most people that you're going to talk to at the call centre aren't licensed to provide personal advice.
But that's why most people are calling their fund as well.
Exactly.
I need help. What should I do?
How do you pay for that? There is a provision for collective payment for what's called intra-fund advice, which is really advice about your interest in the fund, which is really, can I take out can I start an account-based pension? And they're able to go, well, are you over 60? Have you met a conditional release? Here's your balance. You must take 4%, whatever. That's provided for. So as long as it's about your interest in the fund, then that's fine. But most people's assets are stretch well beyond their interest in the fund. They'll have a family home usually. They'll have a interest
Yeah, and
in
that's
the fund,
interesting.
and they'll have
You
some
can call your
insane-
super fund for advice and get maybe free advice on the actual fund. But if you've got an investment property, some shares, some other lifestyle things, some downsides of things, you will need to pay extra if that fund offers the advice.
Yeah. And so many funds, not all, but many funds also provide member-paid funds where the individual member pays for it. Many of those advisors are limited. So every financial advisor has what's called an approved product list, which is the products on which they can provide recommendations. And many of the funds, not all, but many of the funds, limit their advisors to talking about their own products, which means if you're 100% confident that your fund is the answer, then getting personal advice from that fund is a very cheap way of getting it.
Yeah.
But obviously it's not going to, they're certainly, if you go to an Australian super advisor, they're not going to recommend you move to Host Plus.
I dare say no. So look, we're going to leave it there. It's a shorter episode today because we are recording in the ICC. I'm attending the South by Southwest festival and we've had a bit of trouble with security. And it's so funny, Vince, like I was sitting here for an hour before you got here with the audio gear up and, you know, there's people filming with their iPhones everywhere. Set 2 cameras up. Everyone goes into meltdown. Like, it just blows my mind.
Yeah. I'm going to see Teddy Swims tonight at the Kudos.
Right.
Displaying my hipster millennial tendencies here.
I don't even know if I've heard who that is.
He sang at the NRL final.
I didn't even watch that.
But there's a list of requirements at the venue. So you're not allowed to have a camera that's got more than I think it's a 5 centimetre lens.
Yeah.
Like it's just...
Anyway, it blows my mind. We're in a public space. They've told us that we're in a public space. Yes, we don't need a pass. You don't need a pass to enter the public space, and you can film in here, but you can't film ICC staff or ICC logos. We're not doing any of that. And then another security comes, and anyway, we're done. We're done. I just wanted to jump on and give everyone an update. We will do another episode in the coming weeks if we hear more changes around this super stuff. So Vince Scully from LifeSherpa, and you're on the show next week. We respond to some spicy comments that were in
I love
the
a bit of
Facebook.
spicy responses.
All right, see you, friends.
Bye-bye.
Oh, and also, everyone, if you found this podcast useful, can you please see if you can share it with a friend or family member? It's really how we grow, and we love what we're doing here at Retire Right. So thank you very much, everyone, for having a listen today or a watch on YouTube. We'll see you later. Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive, Pty Ltd, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Martin McGrath, Financial Edge Group, and its employed financial advisors are authorised representatives of Synchron Advice, AFSL 243313. Opinions or comments from any guest on the podcast are theirs, and not those of the hosts, the publisher, or their respective licence holders.